At the time of recording this video, the top 3 performing funds in the large cap category were the DSP Equal Nifty 50 Fund, the Principal Nifty 100 Equal Weight Fund, and the Sundaram Smart Nifty 100 Equal Weight Fund. This was definitely a surprise to us, and we wanted to know more on why 3 equal weighted index funds were doing so particularly well in a category which is generally dominated by actively managed or at the very least by market cap weighted index funds. In this video, we shall put forward the case for and against equal weighting as we examine if it is worth investing in an equal weight index. Globally, there are 3 dominant types of indices to consider. 1, a market weighted index, 2, an equal weighted index, and finally, a fundamentally weighted index. Of these 3 types, the market cap weighted index is the most common one and is used by major indices around the world. These include the S&P 500, the Nasdaq Composite, most European and Asian indices, and of course the BSE Sensex and the NSE Nifty. But just because the vast majority of stock exchanges prefer the market cap weighted index, that really does not mean that it is the most superior one. A popular alternative to market cap weighting is an equal weight index. An equal weight index, as the name suggests, is one where an equal amount of money is invested in the stocks of each company that makes up the index. For instance, NSE has 2 indices, the Nifty 50 index, which is something that we all track, and then there is the Nifty 50 equal weight index, which is based on equal weights. From a holdings perspective, the Nifty 50, which is a market cap index, gives more weight to the larger market capitalization companies and less weight to the smaller companies. Like presently, HDFC Bank and Reliance Industries are the big daddies of the Nifty 50 index and have a combined weight of over 20%. And then as we go down the list, there is Infosys, TCS, Axis Bank, and the weights keep on decreasing until we reach the 50th company in the index, which might have a weight of 0.2% or somewhere around that number. However, in the Nifty 50 equal weight index, HDFC Bank, Reliance, and even Infosys, TCS, Axis Bank, and all 50 companies receive a 2% weightage in the calculations. In other words, there is no undue concentration on a few stocks in an equal weight index, and each index company gets the same weight. In an extension to this, there is also no concentration of a particular sector in the equal weight index, which is certainly not the case with the Nifty 50 index, where financial services take up almost 40% of the Nifty 50 sector-wise split. Financial services in the Nifty 50 equal weight index has to make do with only 22% sectoral weightage on account of the 11 companies that comprise that index. So 2% multiplied by 11 companies comes out to 22% weightage for the financial sector. An interesting comparison between the market cap weighted and the equal weight index is the style of investing. It's generally said that equal weight indices are based on the value approach to investing, while the market capitalization weighted indices are driven by the momentum style of investing. There is some merit in this argument. After all, equal weight indices do have a fine balance of overpriced and underpriced holdings, and while rebalancing, the objective in its truest sense is to buy more shares of companies with a declining price and selling the ones where the price has appreciated. On the other hand, a market cap weighted index continues to increase its holdings in companies whose price has increased, which lends to the momentum style. It's a very interesting way to look at an indexing methodology and its implications on the holdings and the investing style. In fact, let's extend this value versus momentum concept and look at it in terms of some common valuation metrics. In this table here, we shall examine the market cap and the equal weight versions of the Nifty 50 and the Nifty 100 index. The data as of March 2021 shows that while there is not much difference in the price earning or the PE ratio, there is a noteworthy difference between the price to book and the dividend yield between the 2 weighting methodologies. Moving on to turnover, we see that the equal weight indices feature a higher portfolio turnover rate, which implies the equal weight index have higher total transaction costs, which then tends to push up the expense ratio of the funds. For example, we mentioned 3 schemes in the beginning of the video: Nifty 50 equal weight index fund by DSP and 2 Nifty 50 equal weight indices by Sundaram and Principal. Notice here that the expense ratio of these funds is on the higher side as compared to the corresponding market cap weighted index funds. We believe this is purely on account of the higher turnover that happens in the case of an equal weighted index. In the next section of this video, we shall do a performance comparison, but before we get to that, if you're learning something new in this video, don't forget to like and subscribe to the ETMONEY YouTube channel, and do share this video with your friends and colleagues over WhatsApp and Facebook. We shall be focusing on the Nifty 50 and the Nifty 50 equal weight index as we look to compare the performance of either weighting styles. More specifically, we shall be using the TRI or the total return index information of both these indices from 2002 onwards, so that's a good 20 years of data. The table here shows that the honors have been shared equally between the two indices, with each index being the better performing one for exactly 10 years. So there was not much to choose from here, but what's interesting to note is the difference in performance in some of those years. For instance, in the last 10 odd years, the equal weight index has performed better than the market weighted index in 2009, 2012, 2016, a larger part of 2020, and now again in 2021. What's coming out as a pattern here is that in most cases, the preceding year, that is 2008, 2011 and 2015 were all negative years for the Nifty 50. This seems to show that the equal weight index seems to particularly do well in those years, whose preceding year was a poor performing one for the market cap weighted index. So if you're a keen observer of patterns, this is surely something to look at, as it seems to have worked out most times. Another way of interpreting performance, especially for long-term investors, is to use the concept of rolling returns. On a 5-year basis, we see that the Nifty 50 equal weight index was the better performing index until 2013, post which the market cap weighted version of the Nifty 50 started to exhibit better performance. The same trend can be seen on a 10-year rolling basis as well, with the momentum styled Nifty 50 index overpowering the Nifty 50 equal weight index. Actually, this reference to momentum and value makes perfect sense. Even globally, value funds have not done well in the last 10 years as compared to growth and momentum funds, and this has been the case for India as well. For instance, if one had invested 10,000 rupees on 1st of January 2011, 10 years in the Nifty 50 would have yielded 25,700 rupees at 9.9%, while 10 years in the Nifty 50 equal weight would have delivered a little over 21,000 rupees at 7.8%. But you know what? Markets go through cycles. First it was value, then momentum, and now there is some talk across the board of a possible resurgence in the value approach to investing, which might have a positive bearing on the equal weight indexing style. Many investors believe that the choice between a market cap weighted index and an equal weight index is a trivial matter. But the research we have put forward today shows a difference in returns of at least 3% on either approaches and specific scenarios where this difference shows up. If we start looking beyond performance, then the equal weight index comes with low volatility due to its broad and equal diversification, and its construct also avoids excessive valuations during momentum-driven markets. But if the question is which one, the market weighted or the equal weighted one, is a better index to invest in, then honestly we could not come with a compelling knockdown argument. Each approach has their pros and cons, and while we found a lot of grey, we really could not find enough data to pin it in black and white. But we certainly hope some of the insights presented were useful, and you'll add to this conversation by doing your own research on equal weight funds and putting forward your views in the comments box below. Our internal view, though not yet substantiated, is that as a combination of multiple factors, there are some merits in the equal weight approach, but we currently don't have enough benefits to vouch for it. And with this, we come to the end of this video. If you liked our presentation, then do subscribe to the ETMONEY YouTube channel and help us spread the good word by sharing it over WhatsApp, Facebook, and Twitter with your friends and connections. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.